Thank you all very much for giving up a little bit of time in your day to get an update on what's probably the most material update we have as a company for this year. Presenting will be myself, as I introduced before, the CEO of Heliostar, and Sam Anderson, our VP of Projects. Sam really has championed and delivered a lot of the work that's led to this resource update. We also have a new slide deck to show the significant changes that the resource represent for us. So I'm pleased that there'll be a lot more new material to present to shareholders today. So if I begin, I note that we will be making forward-looking statements. You'll be able to find a copy of this on our website for a detailed reading. I think the most important thing to commence any discussion about Heliostar with is what is the business that we are trying to build. We've always been very clear that we want to build a mid-tier producer at Heliostar. We want to be a 500,000 ounce a year producer by the end of the decade. And I think the logic in that approach comes from the way money markets have driven gold companies' merger and acquisition behavior in the last few years. They've got bigger and bigger and bigger just to chase ETF buying because that's been the majority of buying in the space. And so even when I left Newcrest, 100,000 ounces was a big enough hurdle for us as a company to look at the time. Now you'll find very few majors at all looking below 200,000 ounce a year production space. And I look at the B2 Golds, the Yamanas, the Kirkland Lakes, the early gold corps. It's a proven pathway to build a multi-billion-dollar business. And that's very clear, the line in the sand of what we want Heliostar to become. And we believe Anapola is that transformative asset that will take us there. Our portfolio has three very high quality projects. Obviously, our focus in the short term is on Anapola, a significant resource update that we'll discuss in detail over the next 30 or 40 minutes. Huge advantages like having the open pit permit, like the over $100 million that's been invested in the project, and the spectacular deal terms that we got it for given the market conditions at the time. So we paid $30 million total, 10 up front, and all the rest is on milestones that we control the timing of. So very significant for us to get such an asset on such good terms, especially with what we'll introduce in how it's grown. Our other two projects are very good projects. They're very high margin versions of what they are. San Antonio is an option around getting a permit in Baja Sur in Mexico. It's a project that was bought for over $100 million 10 years ago to speak to the value there. And Unga, a very high-grade project in Alaska that just needs significant capital, and I believe will be a multi-million ounce deposit. So I think really deep bench strength, but today it's Anapola that can present the near-term value proposition for the company. In terms of market cap, we're at just under 45 to 50 million Canadian in market cap. We have 167 million shares on issue. That will grow, as I'll mention, with the warrant incentive plan that we've put in place. With the commitments that we've received in the warrant incentive plan, on December 8th, we'll be at $6.5 million of cash in the bank. We recognise that by putting out this resource, we were likely to prompt a series of questions about, well, what's your next funding steps for the company? And so sort of we looked internally and said, how can we come up with the least dilutive way of getting a free run on the back of this resource update? And so talking to a few of our shareholders, most had the feeling that our 30-cent warrants would get exercised. And so why not create an incentive structure around bringing the cash flow of those forward in return for that third of a warrant at 40 cents? A lot less dilutive to add a third of a share to the structure at a higher price point than it would be to do a standard unit financing at these rates. And that was very well received with 4.6 million of commitments today. So that means that our share count will increase by 15 million shares, but our fully diluted share count will only increase by 5. I think looking inside the structure was almost a rights offering and clearly the best way that we could bolster our treasury to achieve our next set of goals beyond this resource. Our share structure remains very mature for a company our size. Big institutional ownership led by Franklin Templeton, Adrian Day Asset Management, Eric Sprott, to name some of the bigger names. Board and management have always put their money up where in every financing that we've done, and we continue to do so. I even buy a portion of in the open market every month. I think it's a nice way of me investing further in the future of what we're building at Heliostar. We have coverage from Roth, and we've recently made watchlist coverage from Claris, Cormark, and 3L Capital. I think as we continue to unlock this, those kind of firms are seeing the clear pathway to production that we present. In terms of leadership, for those who are new to Heliostar, my background's technical, working for big gold companies or big copper and gold companies. Wanted to be more entrepreneurial and moved to Canada. Had a lot of success with Vizsla Silver. I was on the board of Vizsla until early this year, and now the full-time focus on Heliostar. Sam, I think it'd be a good chance to bring you in to introduce yourself.
Thank you very much. My name's Sam Anderson. I'm a geologist with more than 20 years of experience, most of that with Newmont. I've worked everything from very greenfields exploration through development, construction, and steady state operation, most significantly at the Miriam mine in Suriname, where we basically took the mine from very early stage exploration through to operation, and did that on time, on budget, and with a very good reconciliation record.
Thank you. And for those who we've talked to through the year, we've said both at a leadership level and a board level, we expect to bolster the company. Watch this space. We have some additions we plan to make very imminently. So that's something coming very shortly for our leadership team at Heliostar as we build this producing company. It's been an extremely busy year for us. We closed the transaction in March, and we've managed to fit a lot in the time period between March and November. If you look down the bottom, and I've talked about this again, that we laid out a very clear plan in April of how we were going to rescope the asset. We laid out the dates that we would achieve those. They're, to me, the controllables that we have as a country, as a company. And then the outcomes that we thought could deliver, that we have less control over, but we know that by doing the work, and we thought there were some pretty good probabilities of success. I think very clearly on the three levers in front of us that we'll talk through, we've achieved the absolute top end of the range on size and grade of the resource, on the ability to bring high grade forward in the mine plan, on the ability to find new ounces that's going to feed the additional resource growth, and then lastly on the met work, which was really at the top end of what we could have hoped for. Above this timeline, I think you just look at these drill results and they speak to a very rare kind of gold deposit. 53 meters at 11 grams, 46 meters at 13 grams, 242 meters at 9 grams, 72 meters at 8 grams, 33 meters at half an ounce. Then big intervals at over an ounce, 14 meters of ounce gold hits. They make up the headlines of the press releases that we put out this year. Very few ore bodies have those kind of grades over those kind of widths. And that's why we were so excited about this resource update. For people who are new to the project, we are 4 hours south of Mexico City in Guerrero state. We're 20 kilometers immediately northwest of Torex. Torex have been a long-term operating mine in the jurisdiction. In fact, photos, as I say, do a lot more justice than words. This is the view looking south as you stand on the top of the Anapola ore body. What I think is the most compelling part about this graphic is the proximity to major gold mines. 10 million ounce cumulative at Morelos, Los Filos over 15 million ounces if you look at the production history, the reserves and resources. This is a gold belt that creates very large ore bodies that's been significantly underexplored, and we're just sitting at the top of our system at Anapola, and we believe we have a lot more growth, potentially into the range of these deposits immediately to the south of us. They speak to access to skilled staff in the jurisdiction. They show that everything that we're setting out to achieve is already being done a stone's throw from the deposit. In terms of infrastructure, we have a significant leg up on a lot of development gold projects. If you step back and look at the facilities, the camp, the core processing facilities, the decline, the blast magazine, a lot of the development work that would be coming in front of us has already been done because of the history of the project. If you look at what I sort of call the soft infrastructure, in having an open pit mining permit, in owning all of the ground or having 30-year access agreements for the ground that we need that's covered by the open pit permit, that would be very difficult for less than sort of $70-100 million to replace what we have. And it's one of the reasons that we can move so quickly to production. I think it's one of the real advantages that we have with Anapola. And so when we bought the project, we didn't buy it with that open pit mine that previous operators had looked at. We saw a very high grade core to the deposit, and we plan to take it underground. We believe that it'll lower the upfront capital of the project. We believe that it'll give us a better financial return overall, both on an NPV and IRR basis. We think it significantly technically de-risks the approach, moving away from some of the complex mill flow sheet to a vanilla float and CIL plant that we propose. And lastly, a smaller environmental footprint, which we should all strive for as we build modern mines. I think they're the 4 key reasons why we pivoted from the previous approach to our approach. And we saw the 3 key levers that this is a slide that we've kept in for continuity throughout the year. The drill program and its ability to grow the resource, bring significantly higher grade forward in the mine plan, and that network. And so today we can take a deeper dive through each of those steps and talk how we were able to have the success we have on each level. And so if you look at the deposit, the high-grade panel sat at the core of a big low-grade halo, and we recognised it wasn't well enough drilled, and that there was large gaps, and they were having a negative impact on the previous resource. In short, you don't want to smear grade away from drill holes, so you be conservative and you drop the grade away from your known data points. So we tightened up the spacing within the high-grade part of the resource. We volumetrically added to it up plunge, and we added down plunge. We're actually still optimistic about our room to grow that. But 12 of the 13 holes that we drilled into the high-grade panel delivered, significantly outperformed what the resource model hinted at. And I think the biggest suggestion here, or the biggest hint here, was hole 292, which was a geotech hole, which drilled through the deposit, was about a third improvement on the model. And I think largely we've held that improvement all the way through. The best part about it from an economics perspective is the growth's come from increasing the grade of resource blocks. So we haven't had to add more. We've just made those blocks worth more. And bottom line, that means when we mine them, they'll be more profitable. So I'll introduce Sam to step across from what we did to now what that looks like and from Monday's resource update. And Sam, you're on mute.
Mute. Yeah, so taking those drill results that Charles just described and applying those to an updated resource model, the results are exceptional. If we look at our total measured and indicated ounces at a 2.5 gram cutoff, we end up with 711,000 ounces at 6.6 grams per ton, and an inferred resource of 448,000 ounces at 4.24 grams per ton. If we take a little bit deeper dive into that and look at the measured ounces, our highest confidence ounces, the ounces that are at the center of that high grade panel and in the, that were the focus of this year's drilling, we see that we have 320,000 ounces at almost 9 grams per ton in our highest confidence areas. And that's an exceptional result. If we take a step back and look at a slightly lower grade cutoff, if we look at a 1 gram per ton grade cutoff as opposed to the 2.5 gram cutoff, what we see is that we end up with a measured and indicated resource, or measured and indicated ounces of 919,000 ounces at 3.8 grams per ton, with inferred of 974,000 ounces at 2.12 grams per ton. What that tells us is that we've got, again, a very high grade core with a large halo of lower grade around that. And that speaks to the overall size of the system, as well as the potential to continue to grow and to continue to convert lower grade ounces and upgrade those into those higher grade ounces. And if we focus in on the high grade panel itself and look at the distribution of those ounces, we see what we're looking at here again is that same long section, very similar to what Charles presented with the drill holes. And we can see that the blocks at a 2.5 gram cut and above. We see at a 10 gram cut, we have more than 200,000 ounces at greater than 10 grams per ton. In the lower part of that panel, that would be the area where our existing decline would easily access. And what that does for us is it gives us a great starting point for the deposit. That's a massive benefit to the economics, because again, this is something that can be mined very early in the process or in the mine life. Bringing those ounces forward has a very positive economic impact in that it decreases the payback period, as well as increasing and having a very positive impact on the overall NPV. It de-risks a lot of the mining because we have that very solid, substantial, robust, and continuous zone that we would be mining from. And so if we take a look backwards and compare what we have as a resource now to the previous model, we can see some pretty significant changes. So there's a couple of different ways to do that, because we're moving from open pit to underground. It's not a direct apples to apples comparison, but we can look at, we can either compare both resources in context of an underground mine, which is what we're looking at in the upper box there with a 2.5 gram per ton cutoff, or we compare both resources in context of an open pit, similar to what was done in the previous pre-feasibility study, and look at our resource model at a 1 gram cutoff. And that's what's presented in the lower box there. The results are fairly similar, but let's walk through the underground, since at a 2.5 gram cutoff, since that's the most relevant. And what we see are changes across the positive changes and increases in the overall grade of the resource across the board, from inferred to indicated to measured. If we look at the measured and indicated, the overall grade there has increased by 36%. If we look at the inferred ounces, the overall grade there has increased by 14%. Again, if we parcel out and look particularly at the measured ounces, which are our highest confidence ounces, the grade increase there is 58%. That's an exceptional result, and one that has an outweighed economic impact, because it's much better to add ounces inside of an existing reserve or inside of an existing ore block, as opposed to adding those outside. Adding them inside to existing resources has zero additional cost and only benefit as far as recoveries and additional revenue. One of the other things to notice in there is that there is an overall change in ounces in each one of those categories. If we look at the measured and indicated ounces, those have gone down slightly. If we look at the inferred ounces, however, those have gone up dramatically. So there's the 8,000% increase in the inferred resources. And it's important to understand what those mean and what that's telling us. What we're seeing in the shift from measured and indicated to inferred, we're still seeing an overall growth of about 300,000 ounces in the new model compared to the previous model. But the locations of the assignment, the level of confidence in those ounces has changed, and that's completely appropriate for stepping from an open pit mine into an underground operation. In an underground operation, generally the measured and indicated classifications are much more restrictive, and that's exactly what you'd expect. For example, if you look at an open pit mine, on every level of that mine, all the tons get moved off of each bench, and there's an opportunity to reclassify those and send ore to waste or waste to ore, because those are already going to be mined. So there's opportunities there to move ounces or move tons around. In an underground mine, each ton that comes out of the ground has to be engineered and has to be designed, and therefore you want a much higher confidence in the locations of those ounces. And you want, if you say there's high grade that is there, you want that to be there, so that there is a much more stringent criteria for measured and indicated in this current model. And what that leaves us with is an opportunity to continue to move inferred ounces into indicated and upgrade from indicated into measured. And that's an important point, because that was where a lot of our ounce benefit and where our grade benefit came from in this resource. We drilled the center of the deposit, upgraded those ounces, increased the grade for additional ounces at the highest grades, at the highest end, but we really didn't test a lot around in the periphery. We were focused at the very center of the high grade panel. And as we step out, we can do the same thing, and we have the opportunity to do the same thing at those more peripheral areas. And so what we're looking at here in this diagram is a cross section through the high grade panel, north south, looking to the west. You can see the high grade panel, you can see the parallel panel, the depth extent, and that low grade halo of mineralization outboard of that. There's a couple of takeaways from this since we're zoomed in on it. There's a number of occurrences of high grade in areas off to the north of the high grade panel that we believe could be additional east-west structures. And we'll talk to that again here in a few slides as we talk through our exploration model. But just to make a key point here, we had 3 tick marks that we were going for with this rescoping. We had 3 goals in this rescoping: increasing the size and grade. We've demonstrated we've done that through the 58 and 30% increase in measured and indicated resources. We've been looking, we aimed to increase the metallurgical recovery. We've done that up to 80.4%. We'll talk to that in another slide. And we wanted to demonstrate the potential to bring high grade forward in the mine life, and that is the significance of that 200,000 ounces, greater than 200,000 ounces at greater than 10 gram per ton panel at the within the high grade panel. And so just to have another quick view of that and the measured and indicated blocks. If you look in the in these 6 panels, if you look in the far left-hand side, those are our measured blocks. The middle are measured and indicated. The right are our all categories of mineralization. The top row is the grades. So you're looking at a 2 gram cutoff. The bottom is the classification. So you can see the distribution of our highest grade ounces as well as our highest confidence ounces, and look at those things side by side. So as we move from the measured ounces to at the left to the measured and indicated at the right, you see that overall footprint of the deposit still remains very coherent, very compact, very robust at very good grades. There's the potential to grow those indicated ounces. And as we move into all classifications, we see that the footprint grows even larger. And we start to see those potential east-west faults off on the north show up within the model itself.
I think, Sam, that's a really good point, in that most of our drilling was only done in the very core area. So I think we can have optimism as we step out and add ounces in currently the indicated and inferred categories. We think there's ounces to add. We can easily see a couple of 100,000 ounces around that high grade panel by continuing the program that we did above to the south and to the west of the pre-existing drilling. And so the success we've had upgrading the grade whilst upgrading the confidence, we think we can have in our next round of drilling to grow the deposit as a whole. One of the most pleasing metrics that's come out of the resource update is the cost at which we've been able to achieve it. If you look at our cost to hold the project, to maintain a camp and to do exploration, we added those 300,000 new ounces, those high-grade ounces, for approximately $16 a ton. Sorry, $16 per ounce. That's an incredibly strong metric. I think you see gold companies in the world starting to talk about $50 to $100 being a good performance metric for adding ounces. So that leaves a lot of the margin for us to capture when we mine these ounces later. I think another good way to think about it is look at it more holistically as the resource today. If you look at that 1.15 million ounces, if you look at our acquisition costs, all our corporate costs, our camp and exploration costs, we have acquired or discovered those ounces for $15.50 per ounce. That's the most accretive way that we can think of as a management team to create value for Heliostar shareholders. We'll struggle to replicate that going forward, but we'll do our best. We think that there's a lot of low-cost ounces that we can continue to add. This is a slide that we've continued on from before, but it speaks to that. It speaks to the ability to bring high grade forward in the mine plan. And so there's the resource. This is using the pre-existing resource. We have to update the work and the engineering work now on the new resource. But you could see over 5,000 ounces per vertical meter in there, probably more appropriately 3,500 ounces per vertical meter at a 2.5 gram cutoff within that high grade panel. And then within the core of that, there were 200,000 ounces at 9.5 grams per ton. We knew that we could support high grade up front, but the 30% improvement that's up there in the resource is even going to further benefit us. So lift the grade, more of these high grade ounces to really drive that scenario. If you're looking at financial models, these can be $100 to $150 million improvements to the financial outcome of a project just by bringing these ounces forward in the mine plan. I think it's going to absolutely turbocharge the payback and free cash flow that we get from Anapola, because we've got this very favorably located high-grade core right at the bottom of the high-grade panel, which is exactly where you want to start mining. Sam, on the metallurgy?
So the other big step change beyond the resource is the metallurgical work that we're doing. We've stepped away from the historical focus, which was the atmospheric oxidation, and dismissed that as a path that we're not going to go down. We want to go down a very straightforward, plain vanilla processing approach with a focus on the high grade panel. The historic resource was really focused on a lot of the peripheral lower grade mineralization, which left us with some opportunities. And so, there are three important points on this slide: where and why we took the samples, the results of those samples, and what that means to us from a processing standpoint. So we took the samples from the high-grade panel. Again, that's a change in focus from the work that was done in the pre-feasibility study. You can see the locations of those composites in the map at the upper right-hand corner. You can see that those composites represent mineable widths from various areas within the high-grade panel, from the upper east or up plunge eastern portion of the high-grade panel to the very deepest western portion of the high-grade panel. Those are consistent composites, along with a couple of composites that represent lower grade material in the footwall, and composites that represent peripheral material such as the granodiorite and the sediments. And what we see as a result of those composites, 7 of those 8 composites gave us 80.4% recoveries. Those composites represent the high-grade panel, and that's a significant step change from the recoveries that were previously the baseline. So that's about a 10% increase in the overall recoveries. And those recoveries range from 74% all the way up to 88%. We've used these. We're currently doing analysis, and we'll be able to incorporate all of this into the geometallurgical model. The other key takeaway here is on the gravity recoverable gold. We've got work. We have gravity recovery work that suggests that we'll be able to get about 31% gravity recoverable gold across those same 7 samples, which is a benefit to us. It de-risks the processing operation by taking that gold out very early in the process, right after crushing and comminution. And what that does for us, this 80% recovery allows us to economically process these high grades, the high grade panel, using a very conventional circuit, 75 micron grind size, comminution into flotation into CIL, that is comparable to what most off the shelf or what most mines in Mexico are currently using for gold recoveries.
Yeah, it was a tremendous result at the very top end of the range of what we thought was possible. There's more work to be done here. There's still potential for further improvements. For example, we've run those tests in separately. Putting them in series has the potential to do that for us. So that was a really game-changing result for us as a company. The other game-changing result, we knew we were buying a very good project when we bought it with the plan that we had. But in the last few months, we've realized that we're buying something very special. The combination of the significantly improved network and how we can continue to grow Anapola. In some senses, because the cutoff a couple of months ago, the resource that we've put out is almost stale dated in the sense that there's a lot more growth to come from Anapola, and we've started to show some of that. And so this slide's a summary of where the growth comes from with the Anapola deposit. The parallel panel, the expansion zone, the West Breccia, and these newly recognised northern targets give us a lot of potential. I'm very confident that we'll be well north of 1.5 million ounces with a following resource update once we've drilled all these targets. And the best thing about, I think it is the best thing in terms of the right way to explain this, one of the most exciting things for us as a management team is how do you find more gold within this footprint? And it comes back to that exploration philosophy in that most of the work that was done here has holes drilled from west to east, or vertical open pit infill holes. And they were chasing a particular style of gold based on the rocks dipping down to the west. It's what we would have done if we first turned up at this deposit and started drilling as well. But when you get all this data, you've got the advantage of looking back with a significant, set of information behind you. And we recognise that the key controls are these east-west structures. That's what controls the high-grade panel, and that's what we recognise controls a zone to the north called the parallel panel. And so here you're seeing a section looking north of the parallel panel, and you can see all those old holes going from west to east or vertical. They would either drill right into this zone, or they'd be a couple of metres to the north or to the south, and they'd miss it. And so they returned some long intercepts, but they didn't realise that it was a coherent gold mineralised structure. Our drilling consistently went through this area to get down to the high-grade panel, and we started to piece together that this was a continuous zone of high grade that's, we think, going to become a resource. And so we've returned results like 11 metres at 16 grams, 5.5 metres at 4, 2 at 13, 14 at 5, down 4 at 10 grams. We need to realistically just drill this off on 25-metre centres now. We see another 100 to 300,000 ounces of high grade coming from the parallel panel, and it's open down deeper and to the west, as you can see with some of those outlying hits. We think there's a lot of room to grow with the parallel panel. And that was really proof of concept that these parallel structures exist, that there's more of them, and they should be a very attractive target. If you want to simplify what we've done down to its absolute basics, we've just spun the rigs around 90 degrees, and it turns out that's the best way to drill the Anapola deposit, especially if you want to find high grade. You'll recall the decline we saw in the photos. It goes down 400 metres and was supposed to be completed here in the heart of the deposit to drill off the expansion zone that was deeper. Unfortunately for Alio, the owner at the time, they ran into some financial constraints and never completed the decline. But you don't put a decline in unless you're pretty optimistic about the growth potential. There's deeper holes in the expansion zone, like 13 metres at 30 grams, 40 metres at 6, 20 metres at 6. It's open. And I think geologically, it's a very attractive target. In If you go back to the Guerrero Gold Belt slide and look at those ounces we showed to the south of us, they're all deeper and hotter in the geological system. Our gold is coming from down and to the west, we believe, and we think it'll ultimately move into what's known as a more proximal skarn assemblage. It'll have slightly higher copper and still have high-grade gold. That's what all of Morelos complex is. It's what all of Los Filos is. So we think there's a chance that this can grow into a 5-10 million ounce deposit as we go deeper. We think it's best drilled off with a decline in to give you that lower platform. We also think that there's 1.5 to 2 million ounces in the top 300 meters. And that's what we're very confident that we can deliver on next year from these targets all being open. The next of those, which we really stand out in this resource update, is these structures to the north. And Sam showed that section. You can see that there's these little isolated zones of higher grade, 7 meters at 4, 10 meters at 4, 10 meters at 5, but make up small pods of high grade in the resource estimate, but they're just very poorly defined through a lack of drilling and a drilling at the wrong orientation if they're east-west structures. So applying the model that's given us significant success growing the high grade panel, discovering the parallel panel, we think that there's a lot more to come as we step to the north and drill it on this better orientation. Very, very attractive growth targets for us. If you lay that out in section, you can see some of these drill results. You can see the depth that these high-grade zones continue to. Effectively, I have a view that any porosity is good. Any gaps, any space, any holes in the rocks before the gold came in is a great spot to deposit gold, and those go down very deep and give us a lot of potential to chase this to depth once we've tested it all in the shallow area. We have the West Breccia over to the far west, a lookalike target to the high-grade panel. It's got the same size footprint, really good pathfinder elements. We completed 2 holes into there in our most recent drill program that we've just wrapped up. We're waiting for results back from those. If we have success, then we may have another lookalike for the high-grade panel. And then lastly, regionally, we've got a lot of potential. We just highlight San Luis. It's got surface results like 3 meters at 11 grams, a bit over a meter at 9 grams, half a meter at 16 grams. These have never been drilled. The 52,000 hectare land package we have is very big. It's extremely underexplored given the focus on Anapola. But I think ultimately gives us a lot of discovery, a pathway above and beyond Anapola. You can see why in the short term, Anapola is so attractive. We just continue to add ounces with the drill bit, and we'll look to do that as we build up our knowledge and then step out to show what the district can unlock for us. If you ask me what makes Anapola special in terms of a business proposition, I think it has 2 key things ahead, 2 key things that stand out to it. One that I've tried to demonstrate really clearly on this slide, another that we'll really be able to lay home with our economic studies next year. But not many projects can be in production in 3 years. It's a hugely valuable proposition. In short, it means that shareholders today own more of the mine in production than if it was a 5, 7, or 10-year timeline to production. And so I think the simplest way to show that is on this chart here on the right. What you're looking at is 4 scenarios based on time and a hypothetical mine model. I stress that we don't have economics for Anapola on the updated resource, that we have to do these. So these are just hypotheticals for comparison. What you see in blue is the value destruction in how long it takes to get in production in an NPV5 environment. Down a quarter, nearly a third, nearly 40% over stepping out from 3 to 10 years delay in starting exactly the same mine scenario. It's even worse if you think we're more appropriately in a higher NPV environment. You lose half the value of the project by waiting for 10 years if you want to invest in that same project that could be in production in 3 years, as opposed to then in this higher inflationary environment. That is a huge amount of value destruction, and it's why companies should be more focused on getting to production quicker where they can. This idea that you just drill forever and wait for someone to take you over, or probably realistically take you under, as we're seeing in a few deals lately, the benefit of shareholders are getting to production decision quicker is shown very clearly on this chart. And so we're targeting production in 3 years from Anapola. There's no reason why we can't get there with the infrastructure that we have and the permits. That means we'll deliver the rescoped economics next year. We'll look to grow the resource over that 1.5 million ounce hurdle that I'm very confident we'll get to. We'll complete our BFS by mid-2025 and make that construction decision. And then we can be in production at the end of 2026, beginning of 2027. It's an aggressive timeline, but it's a timeline that we can meet because of the back history of this project and the infrastructure that we're piggybacking on. The other key feature that I think stands out is the margin that the Anapola gold deposit has the potential to deliver. If you're delivering these widths at these grades, you've got the lowest mining costs. We're looking at very low, sub 200 million, probably 150 to 170 million capex range. If you look at the neighbouring underground mines around us, they're producing at about $100 a tonne, and we're looking at rock that'll be $500 to $1,000 a tonne that we can mine. The free cash flow that these kind of deposits can generate make them extremely rare in this business. So the combination of how fast it can move and how profitable it can be relative to a low upfront capex is what we think when we do the economics for Anapola will really make it stand out as a compelling business opportunity. And so our next catalysts, they're very clear in where we're driving. We actually have a very good conundrum right now. We've got this simultaneous ability to show the studies, to show the economic value of what we've defined in the resource update, but we also know it can grow. So we've got to make a decision in the back end of this year to present early next year. Is it going to be resource update first and then study, probably PFS, or is it going to be PEA on what we have now, then resource update, and then into feasibility study? Either way, we'll have an economic study out next year. We'll have significant resource growth to come from the targets that I've laid out. We'll have the drill results from those targets. We'll have significant de-risking in the mine planning and technical work that we'll build off the back of this resource. We will deliver the feasibility study by mid-2025. And we're also working on a plan that's a little unique and parallel to that. We are looking at the most cost-effective and quickest way to push this decline that you can see on the right all the way into the ore body. We think by bringing that forward, we have the potential to mine a bulk sample. We can significantly de-risk the studies that we're doing, potentially even use the gold that will be in that bulk sample as a non-equity pathway to deliver that. Obviously, if we can do that, it would be very, very it would be very beneficial for our share price, because delivering that without equity dilution would be very strong. But in short, sort of to close the opportunity that we see at Anapola today, we came this year with a very clear plan and 3 possible pathways to get us to today. As to repeat, that's the resource growth, the now 1.15 million ounces, very top end of what we thought could be in the 3 categories. The high-grade part of that coming forward, 200,000 ounces a year at better than 10 grams. Every gold mine in the world would love to start mining in that kind of ore. And then thirdly, the met work. That was at the very top end of what we thought was possible as well. And so that's really given us a strong basis to move forward, which is to demonstrate the economics of the deposit that we have, do the studies to de-risk it, continue to grow all these open zones which we know are there for expansion, and then be the next gold mine in Mexico. I do not know the large-scale mine that can beat us into production. And so if we can move that quickly, if you've got a favourite gold project somewhere else in the world, you can invest in Heliostar, get the returns of us taking it to production, and then go and reinvest that capital in your mine that's got 5 or 10 years before it gets into production. Anapola is fundamentally unique because of the size of the ore body, the grade of the ore body, and the speed at which we can take it to production. I'm going to stop the presentation for a second and ask anyone to post any questions in the chat box, and we'll look to take questions for the remaining 15 minutes for those who have them. Let me just bring up the question, sorry. Okay, here we go. Sorry, everyone, I was clicking on chat, not questions. Operator error. So the first question is, well, thank you, great update and congratulations on the resources. Is there any idea on the grade of the northern panels from the historic drilling? So allow me to share my screen again. And so we've labelled on this presentation some of those grades. So, some really nice wide intercepts in that 4 to 5 gram range. To be clear, there's very few intercepts in this part of the world. My expectation is the grades that we could see would be very similar to what we've seen in the parallel panel and the high grade panel, in that 5 to 10 gram range. There's some nice intercepts for us to build off. They're just under 8 meters at 4, just under 11 meters at 4, and 10 meters at 5, as a couple of examples of drill intercepts in that area. Another question is, how do the grades at Anapola compare to our competitors? I think going back to those results, I think if I chuck in the combination of grade and width, if you look at this ore body, you can see as you move from west, 85 meters at 4, 98 meters at 6, 130 meters at 6, 118 at 5, 101 at 8, 104 at 6, 100-meter intercepts all the way across the ore body, at 5 to 10 grams, and very high-grade 10 to 20 gram zones in the middle of that. Very few gold deposits in the world can return those kind of intercepts. So I think very few of our peers can meet that. If you can find projects that have these kind of grade and widths, you should seriously think about investing in them because they're rare. Another question, looks like great targets nearby and north. How much bandwidth, dollars, meters do you want to dedicate to earlier stage generation versus the de-risking steps next year? I think we want to do both in parallel. I think there's a clear opportunity for us to continue to grow the deposit as well as do those studies and take the resources that we've already defined through the steps that they need to production. So I think we'll probably put a roughly 2/3, 1/3 weighting, 2/3 on reverse resource conversion and 1/3 on to testing these new zones. And as we see in the parallel panel, it's gone from testing a concept to now needing resource drilling. So we think that's going to continue as we step out into these other areas. Another question is, can we review the costs of the plans going forward? So there's two pathways. I think we're talking about roughly $1.5 million to update a PEA if we go directly to a PEA on the resource that we have. We've got approximately, if we want to do 15,000 meters of drilling, which we think will bring the resource over 1.5 million ounces, it's about $7 million of Canadian worth of drilling. As I touched on, we're looking at scenarios to bring that decline down. That'd be in the $10 to $15 million range. But I note that we could recover probably close to $30 million worth of gold by doing that. So a number of options in front of us. Now that we've completed the resource, we can define that drill program, that resource conversion and upgrade program, and present that to the market. But we think that for something in the ballpark of about $15 million, we can meet the construction decision. And we've got this parallel pathway looking through non-equity solutions of putting the decline down, which we think would be a very beneficial outcome. The question on how much time it would take to complete a decline. The previous decline was going down at about 5 meters a day. If we want to be a bit more conservative, just from a budgeting perspective and said 4, that would take us about 9 months to have the decline down into the ore body and starting to develop that stope. Another question is, how much in total do you expect to take in from the warrant conversion? And do you plan to finance the extension of the decline? So sorry, I probably answered part of that question. We're looking at quite an innovative solution to that at the moment. Talking to people who like arbitrage on gold price, talking to people who like securing offtake commitments from mines for that financing of the decline. We've received commitments for 4.6 million of the financing. Of the warrant conversion. We think that's an excellent uptake. I think there's the potential that we see more of that now that we're trading in and around 30 cents. I think we'll see a bit of a cap on our share price until next Friday, until that's lifted, because people are getting a free third of a warrant. If they do undertake that conversion now, it makes sense to do it, which is why I think we've seen the uptake that we have. I think that gets us a strong treasury that we can really move, particularly after next Friday. Another question is, what is the cutoff grade at Media Luna? So we've used a 2.5 gram cutoff grade. Media Luna, that Torex have to the southeast of us, has a 2-grade resource, a 2-gram gold equivalent resource as the cutoff grade of their resource there. So we've been a little more conservative. We think it more represents what mining costs can be. But we have been conservative in both the estimation process and our cutoff grades. Ultimately, we believe that we have to deliver the gold out of this mine. So we've built a fair amount of conservatism into our approach so that we can continue to deliver. It's a reputation that we treasure at Heliostar, and we look forward to continuing to deliver on. And this resource, we think, should be conservative to help us do that. Another question of, are there any royalties on the property? There's a fixed 2% royalty owned by Triple Flag. It was formerly owned by Goldcorp, who had the property about 15 years ago. They sold it as part of a package to Mavericks, and Mavericks was recently acquired by Triple Flag. So there's a 2% royalty on the project. Some more questions, sorry. Can you discuss the impact of the new mining laws in Mexico? So I've said it before, I think they're broadly negative for the country. Perversely, they make having an open pit permit like Anapola has particularly valuable, although I note some of the constitutional challenges are proving successful. And so I still think there's a lot more water to go under that bridge before they become the rule of the land in Mexico. I have a very positive view on mining in Mexico. I think people that I've worked with in Mexico have a proven ability to just get things done. And I suspect that you'll see a watering down over time, either in operation of or in constitutional challenges to these mining laws. I personally don't think you've seen the last open pit in Mexico. But oddly enough, it doesn't have a big impact on our approach. We will modify from an open pit permit to an underground permit. They're still routinely granted. We think it's about a 12-month timeline. We'll look to submit that early next year. We intend to have the underground mining modification that we need and the Bankal feasibility study in hand the same time in the middle of 2025. Are there any similarities or differences in Anapola compared to mines to the south? I touched on that a little bit in the sense that geologically they're all part of the same system. And it's a pretty spectacular system if it can create monster ore bodies. If I bring back the slide deck, as you can see in this graphic here, there's not too many parts of the world where your neighbours look like this. And there's no other resources to find in this belt. What's most interesting is, as I touched on, geologically, they're a lot closer to the intrusions that drive the system. It means they were deposited with slightly higher temperatures. It means they have a little more copper, and they're distinctively very close to those source intrusions. We know that we're more shallow and more distal. And so that means we have that full profile to chase down to depth. And that's where my optimism comes, that Anapola could ultimately become a very big ore body. Another question of what skill set are we adding to our advisory board? We propose both at a management level and a board level to add very particular Mexican mining experience. So look for people with experience in the jurisdiction, geotechnical, mine building backgrounds. That's what we'll be looking to add to our board and management in the very short term. What percentage of your expenses of G&A and what were they over the last 2 years? So we spend about $200,000 a month on our G&A. It's probably not fair to take it back before March because it's jumped significantly this year than before. It was very lean before that at just under $100,000 a month. But given that we've taken on a much more significant asset with holding costs, we've seen that jump to about $200,000 per month. There was a lot more of that expenditure early in the year as we got the camp up and running and set up. We've pulled that a bit back a bit now in the back end of the year, and we see that going forward at about that range. Another one is, and sorry, I'll keep answering questions while people are prepared to post them. How is the security situation in the project? What additional levels of security do you need in Guerrero state versus Canadian locations? So I think everyone knows that Guerrero has a pretty poor reputation from a security perspective. It was a particularly tough place to be from about 10 to 5 years ago. To answer the question very shortly, we don't have any security at site. We just have people there monitoring the facilities that we have. We haven't had a need for that. We've had really good community support. If you look down the road, and this graphic's a good example of it, Torex had the 10th largest gold producing mine in the world last year. We came up past now 5 years of quarter in, quarter out, steady state production. So Mexico has challenges like everywhere else in the world in terms of security and control, particularly with organized crime in Mexico. Fortunately, it hasn't really overflowed or overlapped to affect businesses operating mines, particularly in Guerrero in at least the last 5 years. And so we've been able to just get on with the job. As you raise your profile, we'll look to ultimately raise our security, but ultimately at the same level that every mine does. So far, we found it relatively straightforward to operate. And again, having a neighbour just down the road doing it, I think, has probably been a clear guidepost to investors of what can be done in this valley with these kind of deposits. After the warrant conversion, how many months of expenses do you have? We'll have a minimum of 6 to 8 months, depending on how aggressive we want to be. We'll wait to see what that final number is in a couple of weeks, and then we'll lay out a plan. At a minimum, it'll have a PEA. It may also begin to bring in some of that resource growth on top of that as well. We'll make that decision once we see what the total warrant conversion is. I'll reinforce, though, that we believe the warrant conversion was the least dilutive, best outcome that we could undertake for shareholders. And I think once that period closes in a couple of weeks, I think we'll really see the benefit of that as shareholders. Was there any thought given to using Stope Optimizer software to report resources versus reporting all in situ resources over 2.5 grams? Sam, I might bring you in. That might be a good question about the way we look at resource modeling.
Yes, the answer is we are running the Stope Optimizer, but that's a next step, and we will lay that over the top of the resource. What we wanted to do was understand what the broader resource is. Now, the overall impact of that, you can see the nature of gold mineralization, how compact it is. We feel that the conversion rate there is going to be very, very high, obviously, because you've got a body that is very amenable to open stope, transverse open stope mining methods. So yeah, the answer, in short, yes, we're going to be putting a Stope Optimizer and be able to incorporate that into the next steps.
And so we've hit the top of the hour. Thank you, Sam. So I'll answer one more question, probably because I like the look of it. It's a dangerous question to ask a CEO. But simple question: what do you guys think the market cap will be at the end of 2024? Gold price should lift the share price significantly, especially after the, it's very nice platitudes on the presentation. Thank you. It's always a very dangerous thing. I can say, 200, 300 million market cap. I think what really matters is we bought a project at the bottom of the Valley of Depression in the Lassonde curve. And we knew that we stood from a sort of 0.1 NAV re-rate to a 0.3 to a 0.6 to a 0.8 to 1 in production pathway ahead of us in a very short period of time. If we deliver that, we should be 5, 10x what our current market cap is today. I think the other way that you can think about this is we knew that's what we were buying and what we were delivering with the rescope. What we didn't truly understand is we also had a project with a huge amount of capacity for resource growth. So in some instances, we're in the growth part, the discovery part of the curve, as well as in that de-risking part of the curve. And so I think on either metric, on the ounces that we plan to have by the end of next year, or the relative de-risk status of the project, I think we can look to a significant multiple on our current market cap. And we've tried to be innovative in how we've gone about the project, how we've looked to raise money as a company. We'll continue to be very innovative as a management team. And hopefully the next update we have is around getting that decline in and some clever ways to do that. So we've got the standard growth and de-risking path ahead as a company, and then we'll look forward as a management to try and pull off some more innovative ways of de-risking the project with the decline and the bulk sample. So thank you everyone for your time today. If I haven't answered a question, please feel free to reach out directly. You can find this presentation on the website, and we look forward to delivering more high-grade drill results and delivering the next gold mine in Mexico. Thank you very much for your time.